Thanks for listening to Investor Insights, a behind-the-scenes look at investing with Fund That Flip. This series provides an insider's look at how our business works and answers your frequently asked questions so that you can make better investment decisions with your hard-earned capital. Now, our founder and CEO, Matt Rodak.
Welcome to this episode of Fund That Flip's Investor Insights. I'm your host, Matt Rodak, founder and CEO here at Fund That Flip. So one of our core values here at Fund That Flip is transparency. We want to celebrate the wins and own up to when things don't go as planned, because we believe accountability is the best fertilizer for growth. So to that effect, a few years ago, we started posting our loan performance stats on our website every month. We believe that investors should know how our portfolio is doing as a whole, and also believe it's a good way to help keep our team publicly accountable. So if you're not familiar with this, check out our blog. And then on the right side, there's a section called tags. And if you click the performance review tag, you'll be able to see all of our performance and those performance reports over time. So to take this idea of transparency to the, kind of another level, we thought we'd talk about these performance metrics each month and then try to give a bit more context on what causes some of these loans to become troubled. And as importantly, what we do from an asset management perspective to protect investor principal and try to get to a liquidity event as quickly as possible. So joining me today for this conversation is Chris Drott, our Senior Vice President of Operations, who is intimately involved in this part of our business. Welcome to the show, Chris.
Thanks, Matt. Excited to be back.
Yeah, I should say welcome back to the show. So if you'd like to learn a little bit more about Chris's background and check out episode 2 of Investor Insights, Chris gave us a little bit more about his background and his journey here to Fund That Flip, as well as some of his experience, flipping houses personally. So check out episode 2. Okay, Chris. So maybe let's start off with just for everyone a high level of our definitions of kind of default. If people are looking at the blog and they're looking at that table, we categorize things differently. So maybe just talk about how we categorize these loans and how a loan makes its way into one of these buckets.
Sure, glad to. We typically divide into 4 buckets: 30 to 60, 60 to 90. 90 plus, and foreclosure. When we talk 30 to 60 day delinquent, these are folks that have fell behind on a payment, maybe just a second one. Typically, when things hit in that bucket, they cure relatively quickly, and it's a matter of a conversation with the borrower to ensure that they're aware payment was due, confirm whether or not they were on auto ACH, were they outside their prepaid interest period, et cetera. So a lot of what we see in here revolves more frequently because it's a bit more curable and solvable in nature. When we move to the next level, 60 to 90 days, now they've definitively missed 2 payments and are potentially on the cusp of a third. And the sense here is it's not really an error. There's something larger that is impacting the borrower's either ability or willingness to make that payment. So here's where we really start to assess the larger risk of the project and assess whether the legal remedy is really the best approach. And in parallel to even a legal remedy, perhaps, we're looking at what other collateral this borrower may have and how we begin to bring some leverage on our behalf to the scenario to help enforce the really the need and the expediency required here for them to get caught up or find and define an appropriate path to exit the property. Next, we move to our 90 or longer in duration lates. And here we're really in our risk management arena. At this point, we've had multiple conversations with the borrower. We have clear line of sight on progression or lack thereof on the project. And we really have a good sense of where we're receiving honest perspective and where we're not. We got a good idea of valuation, what the local market condition is. We've probably made our minds up in regards to the borrower's ability to execute and likelihood to execute. And at this point, our priority is really on finding an appropriate exit that's both expeditious and as to the greatest extent possible, preserving capital back to our investors. So this is really the stage where all the groundwork that we had done in having empathetic conversations with the borrower, really trying to support them to enable them to finish the job. As we've gathered and learned all that data in the months prior, we're now at the point where we're using that data to help find the best path forward.
Yep.
The fourth to talk about here is foreclosure. And this is a point we get to when we don't believe through normal discourse or even some leverage of attaching to additional collateral or other of the borrower is really going to incentivize the borrower to move quick enough to an exit. Maybe they ultimately want to live on the property, and so they're not willing to put it up for sale. Maybe the progress hasn't progressed enough that the value is back, and they don't even feel comfortable going through a short sale or other. So at the foreclosure state, the legal remedy is really set to one, put a backstop in, so that we really can't allow this to go on through months and years of back and forth discourse. We have to put a date on that calendar, which ultimately is a foreclosure sale that it needs to be resolved of, or we will take it and do so. And a lot of times, once we file the foreclosure complaint, is when we get to a point where we can get a conversation going that's truly with the best intention to wrap this up quickly, whether it be a workout, whether it be a short sale, whether it's a deed in lieu, or whatever the right answer is, because our true perspective is foreclosure isn't our intention. Nobody wins from a foreclosure. They're lengthy, they're costly, and while that time is being spent and that money is being spent, properties tend to devalue. So what happens is you move in inverse directions very quickly. So our goal in this foreclosure process is really to use it as a lever to find that exit that works for all parties involved. And when we can't, that's ultimately the instances where we do take back an REO properties.
Yep. It's kind of the path of last resort, but it does give us an end date to get to some type of a resolution, which at least gives us the property back and gives us some more control to get to that liquidity event. So kind of to summarize, we got the 30 to 60 bucket. We get loans that go in there sometimes accidentally, sometimes because maybe the borrower just needs a little bit more time to make the payment. But generally speaking, loans that are moving in there are oftentimes moving out of there within that kind of same period of time. 60 to 90 days. Now we've got a little bit more maybe concern. Someone's missed 2 payments. We're maybe a little bit further past the maturity date than we want to be. And we're starting to develop an action plan oftentimes with the borrower, still seeking to help them out. And if there's additional collateral or some other things that we can do to create some liquidity, still usually working with the borrower and oftentimes can find a solution forward even there. Once we kind of get past the 90 days and into foreclosure, generally we're moving more along a track that has legal recourse or leveraging kind of the tools that are available to us to give us a firm end date on either getting the loan paid off or taking the property back. And to the extent we can, we're also still going to be working with our borrower to get to a positive resolution for everyone. All right, cool. So first 2 buckets, I think are kind of relatively straightforward, 30 to 60 days. Again, hopefully we're getting those resolved. 60 to 90 days, we're still generally working with the borrower and oftentimes can come up with a solution. Maybe what we could do is to make this a little bit more real for our listeners. Let's talk about a few recent examples of some loans that kind of found their way into that 90 plus or even foreclosure bucket. Kind of what happened, how do we work with the borrower, what kind of solutions did we come up with to ultimately get to a positive outcome for everyone?
Sure, absolutely. I think there's a couple different examples, but one bucket that fits maybe 5 or 6 in the recent weeks is, and I mentioned earlier, is we will look for additional collateral, ways to attach to something above and beyond what we've attached to that point in the process. There's a few different ways we do that, and it's very intentional the way our loan documents and how everything is set up and tied together. But first and foremost, we understand if there are other properties within the same LLC or separate LLCs. which have liens, what those liens are for, what the market values of those properties are. So we will look across a borrower's portfolio and assess, do we want to attach a lis pendens? Do we want to go after putting a second lien or even a first lien on an unliened property? So that's one of the things that we like to do first and foremost when we believe that we've got a leverage problem in working to move this quickly, and or secondly, we believe there's a value problem that we want to make sure that we've got access to additional equity should we want or need it. What we're able to do in those instances is, if any of those properties transfer or are planned to transfer or be used as collateral in another arrangement the borrower might have, they're now in a position that they need something from us. And that's a good position to put ourselves in to give us that leverage to move this towards liquidity. So we've used that quite frequently to our success and really to our investors' success, to enable us to force refinances, to force sales of properties that borrowers likely would not have done either if we weren't holding other funds or properties captive until that was completed.
Yeah, so I think it's worth noting here that generally speaking, we're going to be first working with the borrower to see if they have other collateral that we can perhaps, put a lien against to create some additional liquidity, either to help them finish the project or get current on interest payments. If for some reason the borrower is not cooperating with us, there's also some mechanisms that we have in place to effectively do something similar, where we're able to capture some equity maybe that they've created in some other projects, to further protect our position in whatever loans we have with them. So I think it's worth pointing out is, we're not doing this, without the borrower's knowledge, to the extent that the borrower is continuing to work with us. And oftentimes it is a really good solution for the borrower to be able to, pull some cash out of another property that perhaps doesn't have a lien on it, to create some breathing room to finish their projects.
Right on. And one of the other things we do, and again, for us, it's a priority to remain in constant communication with borrowers so that we kind of have the understanding of what each party is trying to accomplish. Because the reality is our goals and our end game is one and the same, and we want that successful exit. One of the other things we do in the course of those communications is when borrowers raise their hand that they're having cash flow issues, execution issues, other issues that are impeding progress, we will assess based on the current market value, the current condition of the home, and the work remaining, if it makes sense to support the borrower in having Fund That Flip step in and work directly with subcontractors to get the job done. In a scenario like this, what we do is we preserve our investors' investment by ensuring that we're, again, while moving as expeditiously as possible toward an exit, but we are trying to maximize the capital return to the greatest extent possible while trying not to increase risk. So if you look at a home that's been demoed and maybe framed out and the borrower is unable to continue, maybe they're able to get it dried in, they're unable to continue past that point. The point of value on that property in that condition versus what it could be worth is a significant difference. So if we think there's the ability, the relationships in the area with the contractors, we will step in and use the same construction rehab funds, but work directly with the subcontractors as needed, support the borrower in that process, and make payment directly to the subcontractors. And what that does is essentially enables the project to continue. It ensures that the money isn't going to the borrower who may prioritize it in other ways rather than paying subs or procuring material for subsequent work. And what we found there is that material increase in value in certain circumstances really helps mitigate any of that exit risk when it's done, right? Because if you have a partially renovated collateral versus a fully renovated collateral, value aside, what are our options with a partially renovated property, and what are the borrower's options? It's very difficult to refi it, which means It's also going to be difficult to fund it from a purchaser. You're now limited who your purchasers can be, cash heavy investors, etc. So the risk at that point in the project to be able to continue it forward to a state of completion means you can market it at market value. It's not been vacant. It's not an REO. You have the ability to market it to those true home buyers in the end who are looking for a finished home. So we do work a lot with borrowers. And again, through those communications, when you're 30 days late, you're 60 days late, you're 90 days late, we start understanding where some of these issues are and what projects are good candidates for this type of closure when issues do occur.
Yeah, and I think it's interesting. We get this question all the time, like, what happens when a deal goes sideways or gets into trouble? Like what do you guys do? And I think our answer is, always like, it depends, because there's just so many variables, and there isn't, one right way to work, each individual loan out per a playbook per se. I think the thing that we benefit on our team collectively is our creative. We're creative and we're knowledgeable. Across our team on different ways to kind of work things through, right? And I think you gave two good examples. One is, generally speaking, is there additional collateral that the borrower has that we can find a way to leverage up or capture some value in to create some liquidity if needed. And the second is sometimes we take a very active role in actually, managing the project through completion, working with local general contractors, working with brokers and finding buyers, et cetera, et cetera. So I think two good examples of, and there's dozens of different examples of how we, think about working through, projects. And we don't have a lot of them, but, we've originated enough loans now that they do happen. That said, I think right here we have I think some principles, no matter what strategy that, we're working on of doing a couple things. Mm-hmm. Talk us through what kind of those general principles are for, that underpin our strategy, no matter what the strategy is.
Yeah, no, absolutely. Preserving principle is top on the list. Everything we do, every question we ask, every action we take, our goal is to minimize expense and optimizing that return of capital. Every time we make a decision, we analyze which way it could turn, which best case, which worst case, and we always are talking about how do we make sure that we are able to preserve principal on this deal to the best we believe. Now, we do that with a balance, and that's the speed of which we can do it. So we recognize that time is money, and our investors are looking to be able to use this money for purposes, hopefully to reinvest it with us. But we do realize that they want that money returned and the ability to decide how to use it. So we will always consider the timeline. And if the risk is lower and the timeline is quick and the principal is, slightly less, that's a weighting factor for sure. Because if I put $1 in my hand today against maybe putting $1.10 in it tomorrow, I know I'm going to take that dollar, and we try and protect our investors' money as vigorously as we would protect our own money. And lastly, I think it's probably been a mantra you've heard through this entire conversation, communication. It all starts with communicating. And our view with our borrowers is you got to be honest with us. We're going to be honest with you. Our goal at the end of this is 100% aligned, 100% of the time. And that is, we want to see the borrower successful, and we want to see this paid off at the term of the note. Now, even when some of that derails, we still remain aligned, that we want to see the borrower get out of this as quickly and as little scathed as possible. And all of that goes to borrowers will talk to us because they know we're willing to work with them, and they know we are in that alignment, which enables a better dialogue. So our ability to communicate with borrowers and vice versa really helps us support them and exit these deals and highlight issues maybe before borrowers have realized that there is an issue, that we might catch something and highlight it to them and work through it with them. So that communication pattern really enables us to hit the other two principles I just mentioned.
Right. So a lot of different strategies, a lot of different paths forward. The thing that kind of underpins all of them for us is, one, a focus on preserving principal, weighing a lot of different options on, Should we finish the project? Should we just sell it today? Which is going to give us the best opportunity to preserve the principal? And we're balancing that against the speed of liquidity, right? So while there may be a higher probability of getting principal back if we finish the project, but it takes us 6 months and there's a lot of uncertainties, there's a trade-off there. And perhaps it makes sense to sell the property in its current condition quicker, maybe for a little bit less, but to the extent that we can still preserve principal, that's a decision that we're going to look at. Regardless of what the strategy is, we're going to communicate. We're going to be communicating with the borrower, and we're going to be communicating with our lenders on where things are at, what our strategy is, what steps we're taking to move the project forward, and as things change, as they often do, providing relevant updates all through the platform. So that's it, Chris. This was great. Really appreciate you jumping back on here to talk to us about what you and your team are doing on the asset management side of our business. If you guys listening have any questions about our process or want to get a hold of Chris or anybody on his team, the best place to do that is to email investorrelations@fundthatflip.com or give us a call at 646-895-6090. Otherwise, be sure to check out the blog. Again, look for that performance report tag on the right-hand side, and that'll bring up all of our historical performance kind of record. And there's a lot of other good content there as well. So thanks again, Chris.
Oh, thank you, Matt, for having me. I enjoyed it.
Yeah, and
hopefully we'll do it again soon.
We will. We'll do this. We'll do this every month. So we'll be doing these portfolio reviews every month as the statistics come out. So check back next month for this one, and then also check back next week as we will have someone else here from the team doing a bit of a deeper dive into some of the other things we're doing here at Fund That Flip. So thanks again for listening. Until next time, this is Matt signing off.